Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50-year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast-track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
Good evening, everyone. This is Niyi Adewole, host of the Ekabo Home Financial Freedom Podcast. And tonight we are joined by Thomas Castelli, who is a CPA and tax strategist, as well as an investor who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of Uncle Sam's hands. He works with the Hall CPA group, which is featured on Bigger Pockets, and he's actually my personal CPA as well. Thomas, welcome to the show, man.
Thank you for having me, Niyi. I'm happy to be here today and happy to hopefully help some people reduce taxes.
Come on now. That is a conversation that I was scared to have for the first couple of years in investing, and I was all about just trying to do it myself. And I can tell you that these last few years of working with you have been amazing, and it's definitely helped me get over those fears. But how did you get into the tax world in general? Was this something that you always wanted to do?
You know, that's a great question. So this kind of a two-prong approach on how I got here. So the first one was my aunt was an accountant. My mom was a bookkeeper, always kind of pushing me towards the accounting field. So when I went to college, my guidance counselors were also like basically go for accounting. So I went for accounting, came out, started my career at BDO, which is a national accounting firm. And kind of along that same time in college, I started learning about real estate investing through books like Rich Dad Poor Dad and so on and so forth. And I started going to different meetups and events, and basically stumbled upon this community that taught me about real estate syndication. And I was like, oh, this is a great business model. I fell in love with it. And with a few dollars that I had, it wasn't anything major, I was able to get into some limited partnership deals with some mentors who kind of showed me the ropes of real estate. And this all kind of went on as I started my career at BDO. By the time that happened, I was like, okay, I want to be in real estate like actively. And I had been on LinkedIn and I saw Brennan Hall, the founder of Hall CPA, posting about his firm and how he helps investors reduce taxes. I was like, well, this would be a great way to kind of combine the two together, the passion for real estate, the accounting background. So I ended up starting there as an advisor and kind of worked my way up through being an advisor to eventually being an advisory manager and so on and so forth to be a partner. And so that's kind of how I got into the position that I'm in today.
Come on now. And I love the backstory and specifically, as you know, I'm a realtor. And I talk to a lot of clients on a day-to-day basis, and this is what I'm advising. When we're working with our investor clients, which is the majority of our clients here, we're like, hey, if you're going to work with a lawyer, go find an investor-friendly lawyer, somebody that's actually doing it themselves. And if you're going to work with the CPA, you should do the same thing, because I know for a fact, having worked with different individuals, that if you are an investor yourself, you're going to look at it with a different lens, right? You're going to be able to break down the tax code in a way that's going to benefit your business, but also many others. And so I love the fact that you were really searching and seeking out investment first before becoming a CPA.
Yeah, no, that's thank you. And I think that's just a unique angle that not many CPAs come from. There's definitely CPAs out there who do invest, but having that angle and being able to see it from the investor perspective does go a long way.
Yeah, and it's one of those things where I didn't put as much value on the tax savings and this whole strategy until I got deeper into the career to understand, like, hey, this is truly how you can actually win at this game. Can you just help explain to those that are a little bit newer the benefit and the reason they should probably seek out an investor-friendly tax professional sooner rather than later if they're still doing it themselves on some of these online sites?
Yeah, absolutely. So a lot of times when you're doing it yourself and maybe you have a job and you have a few brokerage statements and maybe some tax credits that you're getting, it's relatively straightforward to do it on like a TurboTax or H&R Block, so on and so forth. But what ends up happening is as you start getting into business or perhaps you get into real estate, things become far more complex quite quickly, and the learning curve can creep up on you pretty quickly. And the way I look at taxes, it's a matter of intellect. Anybody could figure this stuff out. It's a matter of specialization. So what happens is if someone who's maybe a real estate investor, they have a job or a business, that's your area of specialty. And in order to kind of get proficient at the more complex real estate and business issues when it comes to tax, you'd have to put a lot of time studying and practicing it to really become proficient. And there's just a lot of errors and missed opportunities that could be had if you continue doing it yourself as you kind of move into the more complex areas. And I'd say even go further than that. It's not the highest and best use of your time as well. If you're in real estate, your highest best use of time is probably finding your next deal, managing or optimizing your portfolio, getting financing, things like that. Or if you're running a business like being a real estate agent, it's working with clients. It's not necessarily doing taxes. So it just from not only just from peace of mind and accuracy and tax saving standpoint, does it make sense to find a specialist in this, but also just from a time perspective and sanity perspective, it just makes sense to find that. And the last thing I'll say on that is kind of like what you referenced. If you're going to have a lawyer, go find an investor-friendly lawyer. Same thing with CPA. Same thing with a property manager. Same thing with a real estate agent. So having the right people in the right seats is just a good fundamental business principle, and it's no different for having the right CPA in the right seat for you and your business.
Come on now. That is spot on. And it's one of those things that I think we all learn in due time. But to your point, if you're able to get started early, especially with that first property, man, you're going to be well set up to truly take advantage in the long run. And I have personally benefited and seen the benefits of thousands upon thousands of dollars in savings, even ranking up into the hundreds of thousands of dollars in savings from working with the right team of CPAs. And so what are some of the strategies you can talk about that you've used or are using in this day and age to help clients save and move through that tax bracket?
Yeah, absolutely. I can lay out a handful of them right now. So the first one is going to be just understanding how the passive activity loss rules work. So if you have a job or a business, that's considered earned income. That's taxed up to 37%. Plus you have state taxes and FICA taxes and self-employment taxes. Very highly taxed form of income, but often a necessary form of income to provide for ourselves, also have the money to invest. However, with real estate, it's a little bit different in the sense that rental income, to be fair, is also taxed at ordinary income tax rates. But then you have something called depreciation, which is a non-cash expense that basically just tracks the deterioration of your property over time, despite the fact it may actually be appreciating in value. So this depreciation expense allows you to shelter, the first thing is it allows you to shelter your rental income from tax. That's the first benefit and the first thing that you want to make sure that you're optimizing. Believe it or not, we've seen clients who have substantial rental income that they're paying taxes on, and we were able to help them just through understanding how to use passive activity loss rules, shelter that income from tax, and save money just by doing that. So that's just one part of the bracket, or one rung. The next thing is if you are able to use something like the real estate professional status, which is effectively for full-time real estate investors. It allows you to take these losses that you're generating from your rental properties. And again, these are typically non-cash losses, so you might actually be generating money despite actually telling the IRS that you're losing money. And if you could take these losses, use to offset the income you're generating from your job or a business, you can get tax refunds or just not have to pay the quarterly estimated taxes perhaps. And you're able to keep that money and go ahead and use it to reinvest your portfolio. So reps is one of the ways. And next thing we have short-term rentals. So perhaps you can't jump into the real estate professional status because again, it does often require you or your spouse to work full-time in real estate, but short-term rentals, because of the way the tax code is written, basically says short-term rentals are a business, and in a business the criteria is not as heavy. You just need to be materially participating in your business, lower bar, but that can unlock substantial tax savings as well. Two more things I'll just say here on my little rant is that it goes beyond that. So with assets in general, including stocks, bonds, and especially with real estate, you can get loans against these assets. And we're very familiar with that in the real estate world, but you can do a cash out refinance, pull money out of the property, tap into that equity with tax-free loan proceeds, and use it to presumably continue to build your portfolio while maintaining that asset. So you don't necessarily have to sell. And billionaires like Elon Musk do something similar. He did it with his Twitter stock. He had a bunch of Twitter stock. He got a loan out against it, kept his Tesla stock, but was able to tap into money tax free. Same thing with real estate. That could be applied. I think that's often overlooked. The last thing I'll say is that when you do need to sell a property, is that that is oftentimes we're going to have the biggest tax event because capital gains can be significant, especially if you force depreciation on a property through renovation. So There, you can use a 1031 exchange to defer the taxes by buying another property, and usually a bigger or better property, and continue to build your wealth while mitigating the tax exposure. And there's other strategies as well, but I say those are probably the biggest ones, the biggest keys on things that we're doing to help people reduce taxes.
Come on now. And the fact that you can rattle those off in succession and give the detail of answer in that short of a time lets me know that you've been doing this with many, many clients and are professionals at it. And I want to dive into just a couple of them because I get questions on this all the time. And I've sent a couple people your way that had questions on this, and you've been able to expertly guide them. But I want to provide a little background on one of the pieces that I personally use and then ask a question about it. So when I was working the W-2 and still in medical device sales, I had a bunch of long-term rentals, right? I didn't necessarily tap into the short-term rental loophole, but on the long-term rentals, I was just taking the normal depreciation over 27 and a half years, right? And I wasn't actually able to use it because I had so much active income.
Yeah.
But it built up in a way that when I was considering making the jump into full-time real estate, that was one of the considerations. Like, hey, I could actually write off a lot of taxes if I can qualify for this real estate professional piece. Yeah. And that was something that you helped guide through and I was excited about. But when you talk about that real estate professional status, is that something that's possible to achieve while you're working another job? Or is it, hey, I need to truly be in full-time real estate to make that happen?
Yeah, so it is very challenging to achieve, if not impossible to achieve while you're working a full-time job because the requirements, and I can give some strategies around this, but the requirements require you to work more than 750 hours and more than half your total working time in a real property trade or business. So basically, you're basically effectively working in real estate. Now, the challenge is when you have a full-time job is the IRS looks at that as around 2,000 hours, maybe 2,080 hours in some cases for the year, which is basically 40 hours per week. So in order to work more than 50% of your total working time in real estate on top of another job or perhaps another business that's not real estate related, you're looking at having to work 2,081 hours or 2,001 hours per year in real estate on top of it. So you're looking at 81 hours per week. And the IRS knows that's not sustainable, and really no one's really truly ever been able to fully prove that under IRS audits or court cases. So it's challenging to do. So you would, if it's you as an individual, you would have to move into that bucket fully into real estate to really capitalize on that. Now, if you're married, the good news is that if your spouse can qualify, then if you file a joint return, then you both receive the benefits of the real estate professional status. So that in some cases is a scenario we've seen some couples be able to really utilize. But basically, to answer your question, somebody has to be working full-time in real estate to make that work.
Come on now. And that's huge. But to your point, that is a hack. Go out there and get married, people. And one of you guys choose to be a real estate professional to save some money on your taxes. but that...
So believe it or not, I had somebody come into a tax strategy call one time after consulting with them about this, and they were engaged for a while. They didn't know if they were going to get married officially, and one day they came into the call and they're like, "We got married," and I'm like, "Oh, congratulations!" But they made it happen.
Hey, come on now. And I'm sure that this tax strategy had nothing to do with it whatsoever, but this is awesome.
I hope it wasn't a major factor.
Yeah. And then the other piece that's been huge for a lot of our clients, especially those that from my previous world are working in medical device sales or are doctors or high income earners, is that STR quote unquote loophole. Right? You mentioned it a little bit earlier. It's something that my eyes got truly open back in 2022 now when I started doing cost segs. And now it's a strategy I use every single year, including this tax year. But can you dive into what that looks like and how it works?
Yeah, absolutely. So with short-term rentals, this is a carve-out under the tax code that was intended for hotels and motels. And this is all written back in the 80s and early 90s. So it was before VRBO and Airbnb. And it said that if you had an average period of customer use of 7 days or less, or you had 30 days or less, and you provide substantial services or pretty much a hotel-like services like daily cleaning, daily meals, concierge, things of that nature, then you're not considered a rental activity under the eyes of the tax code. You're now a business. And when you're a business and not a rental activity, you don't need to qualify as a real estate professional to take the losses. What you need to do is simply materially participate, which there's 7 tests in total, but 3 that really are most relevant to most people. And that's going to be you spend more than 500 hours on the activity for the year. or you spend more than 100 hours and no one other person spends more time than you, or you do substantially all the work yourself. If you meet one of those three criteria, the losses from your short-term rentals will be able to offset your W-2 or active business income or any other non-passive income that you have. And to kind of go a step further here, how this differentiates from real estate professional status, with real estate professional status, you or your spouse have to independently meet those 750 hour and more than half your total work time requirement. Short-term rentals or material participation in general, in the business context, the hours of the spouses are combined for these tests. So if you and your spouse, if you spend 100 hours, say you spend 125 hours, no one else spends more time than you, great, you qualify. Or say between you and your spouse, you spend 125 hours, no one else outside of that spends more time, you qualify. So it's a much lower threshold to qualify to make those losses non-passive than the real estate professional status, which has been a game changer just for a lot of people out there.
Absolutely. And this has been a complete unlock, because when you think about going from, say you have 100,000 or 200,000 in taxable income, and now you're able to do this cost seg and take losses of 50, 60, 70,000 based on this property, that's just going to lower your taxable income. It's going to allow you to potentially not even have a taxable income and kind of wipe it out. So I've been definitely utilizing this strategy. I think it's incredible. Now I hear, and I've heard over the past couple of years, it's been kind of going away. What is the latest on that? It's been a little bit less, a little bit less. What does it look like today?
Yeah, absolutely. So the real power behind both REPS and the short-term rental loophole has been something called bonus depreciation. And what bonus depreciation allows you to do is to, it used to be 100% from 2018 to 2022, so I'll start there. What that allows you to do is completely write off certain components of your property in the initial year you acquire it. So most rental properties are either depreciated over 27 and a half years for residential or 39 years for commercial. And that's a significant time period for your property to be depreciated. But what you can do is you can use a cost segregation study, which is basically an engineered breakdown of the various components in your property to get a readout of all these components. Now, some of these components have lower class life, lower depreciation life. So it's 5, 7, and 15 years. And now all of this property is eligible for bonus depreciation. So from 2018 to 2022, you were able to completely deduct pretty much up to 25% of your building's value in that first year. And that was really powerful for a lot of people. But starting in 2023, that started to decrease 20% per year. So right now we're at 40% in 2025. Under the current law. But basically what we're hearing from the current administration is that they want to make a push to bring back that 100% and based on the conversations that are taking place in Congress, it seems likely that will take place in 2025, and we should see that 100% come back. To give some more details, we're looking at that's probably going to come back for properties that you acquire and place in service in 2025. I won't be going much further back than that from what we're hearing, but if that does come back 100% in 2025, that's going to be powerful for people who can access one of these two strategies.
Absolutely. And it makes it more enticing to go out there and get that investment property if you know that, hey, essentially that down payment could potentially just be the tax that you were going to pay to the government anyway, and now you're just putting it toward a property. Why not go buy an asset and keep growing from there?
Exactly. I mean, it's definitely an incentive. I mean, I've argued that it was a significant driver of demand for real estate, or at least a component of it for sure over the last number of years.
And one of the other things that you mentioned in that Tesla example is something that I've just now started to wrap my head around, right? I understood the refinance piece. Like, hey, you can pull money out of a property and have it tax-free because you're essentially taking another loan. But in my mind, until that was done last year, 2 years ago, whenever that deal went down, it didn't make sense that you could actually take a loan against like a stock portfolio and things of that nature. It was like, okay, so you're not going to sell it, you're going to take a loan and save on taxes. Do you mind just digging a little bit deeper into why you don't have to pay taxes if you're going to refinance or get a loan on something? Yeah.
So just the way the tax code's written, loan proceeds are simply just not taxable to you because you ultimately have to pay that money back. That's why it's not taxable. It's just because it's not. Basically, you're just taking a loan out, and that money just happens to be tax free. So I don't know if there's anything special necessarily about that within the code, but that's just the way it works. it's just powerful because you can keep your asset, not have to sell and incur capital gains and worry about that entire thing, but just pull out some of the equity from the property or from your stock portfolio. I mean, you could have an S&P 500 portfolio and just do a pledge asset line and do the same thing there, and it's tax-free. So I don't know if there's anything special from a tax perspective. It just happens to be the way that operates.
That is pretty incredible to me. And so, like, if you wanted to, hypothetically, right, and this is just a hypothetical situation, say you had $100,000 in S&P 500, right, and you needed, $50,000 to go put a down payment on a property. You could essentially take that money in a loan for $50,000, use that for the down payment on the house, be out of pocket nothing, and essentially not have taxes due on that money that you just took. As opposed to if you sold that S&P, you'd have to pay taxes on that piece.
Exactly. That's exactly how it works.
That's incredible. That is incredible. And this is why you want to work with an investor-friendly CPA, to be able to utilize strategies like this in a way that's going to, one, align with the tax code, but two, help you save a significant amount of money. And so I know another thing that you offer above and beyond just doing taxes is the strategy piece. And I've personally benefited from the monthly strategy calls of being able to understand, okay, this is where I'm trying to get to this year. This is my game plan. This is how many properties I want to buy. What's the best way to go about it? And so how did these strategy calls come about, and why is that important for people to have that are continuing to grow their portfolio?
Yeah, absolutely. So a lot of CPAs out there, what they do is they just file your tax returns every year and just say, we'll see you next year. They never really give you any meaningful advice on what to do to reduce your taxes. And the thing about that, filing your taxes is very important, don't get me wrong. But what ends up happening is, because there's no advice, there has to be some way to administer that advice. So what we found is getting on calls with people. Well, let me back this up. So what your tax return is, it's like a report card of the income, deductions, and losses and whatnot that you did the prior year. So where the advice comes in, the advice helps say, okay, these are the things you need to take, these actions, the strategies you need to execute to be able to influence that report card. So by having conversations with your CPA throughout the year on what you can do, whether maybe it's short-term rentals, maybe it is tapping into equity and instead of selling an asset to get access to that cash that you need, these are the types of conversations that basically save you when it comes time to taxes. So if you never have these conversations, you may not have ever made these moves to do it. So we found that these tax strategy calls really help investors get the information they need to make decisions that will help them reduce taxes when it comes time to filing.
Come on now. Hey, nothing like it. I love it. And that's a part of the reason that I went with the Hall CPA group, was for those tax strategy calls, to make sure that I'm on track and keeping you guys up to date on what we're doing, so that we can definitely plan ahead. Because that's the key when it comes to taxes, right? You don't want to come in on, April 1st and say, hey, can you just help me save on taxes? Because at that point, it's too late, right? You got to do it in that year and kind of make it happen from there and have a game plan.
Exactly. If you wait, there's only a few things you could really do after the year ends. It's really important to get a lot of the stuff done throughout the year. So if you're talking to your CPA and you're having these conversations, or here's what I'm doing, here's my situation, they're going to be able to guide you proactively. Okay, this is what you need to do. If you wait till the end of the year, or you wait till after the year ends, there's not all that much that can be done.
Absolutely. And Thomas, what is next? What's next for the Hall CPA group? I know you guys have really niched down to helping real estate investors and investors of all types start to maximize their portfolio and save on taxes. But what does this look like for where you guys are going the rest of this year and over the next decade?
Yeah, absolutely. That's a great question. We're going to continue focusing on real estate. That's never going to go away for us, and we've been fortunate to build a really great team to help investors reduce their taxes. But we're looking into some other different service lines that could help go deeper, like wealth management. We may be bringing cost segregation in-house in certain ways, shape, or form, to further just help our clients with the services they need. Taxes is one part of the wealth management equation. So, like, if we could bring in the more holistic picture, I think that's going to be impactful for our clients. I don't have any specifics to share beyond that. We're exploring it, but that's something that could come up in the foreseeable future within the next 12 months. Next 10 years, I mean, that's big. I think we're going to be looking at other niches. We already have some sub-niches within our firm, just because real estate investors are doing something other than usually investing in real estate. So we have doctors, and we have doctors and dentists and people in tech. So we'll be digging into other niches over the coming years that will add to like the flywheel of people that we can serve. But just to be everybody who's out there who's wondering, real estate's not going anywhere for us. It's not a focus. We're not losing sight of that by any stretch. It's just, how can we serve people at a deeper level? And we've identified certain areas that we'll be branching out into.
Come on now. Nothing wrong with it. I love it. Moving into a couple adjacencies, but keeping the main thing.
Absolutely.
And Thomas, for those that are listening live and also listening later, how can they get in contact with you if they want to talk to you about potentially hiring and partnering with the Hall CPA group to handle their tax strategy?
Yeah, absolutely. There's the best way to do that would just be to shoot me an email. You can shoot me an email at thomas.castelli at hallcpallc.com. Let them know that you heard us here on the show, and we'll be happy to discuss next steps and what that looks like about working with us and how that all works. I also know that you have a link that you could provide people as well that will also help them schedule a call with our team. So those would be the best ways to do it. Either just email me directly, let them know you came from the show, or through that link.
Come on now, done. And we're going to put both of those into the show notes, the link to Thomas's calendar directly and also his email address so that you can connect with him and get some of this advice and help on saving on your taxes. Thomas, we truly appreciate you joining us this evening, man. It's been awesome. And yeah, we look forward to continuing to partner with you over the next decade.
Thank you. Thank you for having me. It's been a great conversation today.
All right, Thomas, be safe, and we will catch you a little bit later. And for those that are listening, thank you for joining the Ekabo Home Financial Freedom Mastermind podcast. Please don't forget to hit the subscribe, the like, and leave us a comment and let us know how we're doing on these shows. If you want to reach out to Thomas, we're going to have his contact information there. And I think it will be a great resource for you as you continue to build your portfolio. Wishing you guys a good day, good evening, and we'll catch you a little bit later.
Have a good one.
Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast-track your path to financial independence.